Hello students, today I am going to start the topic of hire purchase and installment purchase. So first of all, what do you mean by hire purchase? The hire purchase and installment purchase both are so popular consumer financing options, right? So let me go to the next point. See here, you can see here is the definition of hire purchase. Hello students, let me start the topic of hire purchase and installment purchase today. So what do you mean by hire purchase? Going to the hire purchase is a financing arrangement where customers can acquire goods by paying an initial deposit and settling the remaining balance through regular installment, usually with interest. So we already know that hire means to hire something, means to use the goods without taking the ownership of it. Okay, suppose I have some financing problem, but I want that goods, like I want a car, but I do not have sufficient cash money. So that time I can hire purchase that car. Okay, then I can use the car and I will pay the installment. After the paying all the installments, they will transfer the ownership of the car. Till then I have to pay the interest regularly, and also I have to ride the car without the ownership, right? So this is the hire purchase. Now coming to the features of hire purchase, there are several features of hire purchase. Among them, the popular one is ownership transfer. As I have said you now, the ownership of the goods transferred to the customer upon completion of payment term. When all the installment was paid with interest, then the goods will be yours, and the ownership name of the owner, which is written in the ownership title, that will be also yours. Then coming to fixed repayment, the installment amount remains fixed throughout the hire purchase period, making the budgeting easier for customer, right? So every year or every month, whatever be your installment scheme, it will be of a fixed amount. Let's say rupees 60,000, then rupees 60,000 in every quarter, or in every 6 months, or in every monthly, right, or every yearly. So that while calculating interest, it would be easier for the financer and also for the customer to get a ready-made reply or get ready-made calculation regarding this interest, and it will also easy to understand things. Then next, coming to the feature of asset security, the goods purchased act as collateral for the lender, providing security in case of default, right? That means whenever we are going for the hire purchase system, the goods purchased, okay, acts as the collateral, means it is acts as the security for the lender, because risk is upon the lender. So it helps in providing the security, right? Next, coming to the option to terminate. Customer may have the option to terminate the agreement early, usually with additional charges, right? So these all are the features of hire purchase. Coming to the next slide, benefits of hire purchase. So why consumer go for hire purchase? What are the special features of it? Why shouldn't we buy, and why should we hire purchase? Or we will also have other options too. But what are the benefits to hire purchase the things? So first of all, it could have the immediate access. It allows the customer to acquire expensive goods without paying the full amount upfront, right? We can pay a nominal amount like down payment, okay, and we will acquire the asset. So that is the first benefit. Second, flexible payment, which enables the customers to spread the cost of the purchase over a period of time, making it more affordable. Everybody is not rich, or everybody can't afford luxurious item, but a person with this facility can avail the luxurious item with these installments, right? Then coming to the ownership at the end, it provides the opportunity for customers to own the goods at the end of the hire purchase agreement, right? So the ownership of the good is transferred at the end of the term. Next, coming to the advantages of hire purchase for seller, that was from the point of view of a consumer. But now from the point of seller, what benefit does he get when he hire purchase a thing and give his assets and he is not receiving any cash balance? What is the security for him? Why he will go for this type of transaction? So there are so many advantages of this. Among them, first of all, it is increased sale. Hire purchase option can attract more customers because many of people, as I have said, many of the people do not have luxurious items in their home because they do not afford them, but they have a desire to purchase, willingness to pay, but they do not have that purchasing power. So with this hire purchase option, they can afford it. Sorry. Then coming to additional revenue, one more advantages is of the additional revenue. Seller earn interest income from the finance charges applied to the hire purchase agreement. So that will be the main source of income for the hire purchaser, right? Because the vendor, because when we give our goods to the consumer, obviously he will pay the interest regularly. So that will be the fixed income for me. So why do not we go for this option? Okay. Then next is the market differentiation. Offering hire purchase can differentiate seller from their competitors, leading to a competitive advantage, right? Like today in this world, in this era, there is cutthroat competition, but like this hire purchase option, there is no way of we cannot say it is a competition. Even it is it goes to a just like helping options. Next, coming to the disadvantages of hire purchase. So for every advantages there is some limitations, right? So what are the limitations of these hire purchases? So the limitations are higher total cost. Interest charges and fees can increase the overall cost of the goods compared to making an outright purchase. Yeah, this is a common thing. Listen, suppose we go and purchase a refrigerator for rupees 10,000. So we can get it after discount at rupees 9,500. But if we will go for the hire purchase, then obviously we have to pay the regular interest, due to which the 10,000 refrigerator cost will be paid in with interest. It becomes rupees 12,000. So instead of getting the discount, in fact the rate of the refrigerator rises. Not the rate of the refrigerator rises, but paying the interest make it most costlier. But this is the we are convenient that we do not have to pay the 12,000 at a time. We will pay it in installment. That is the benefit for the consumer. But this is the, however, this is the disadvantages also, because the consumer has to pay more than the cost of the product which is available in the market, right? Next, coming to default and repossession risk. So there is the risk that if customer default on payment, the seller has the right to repose the goods, right? In case we do not pay any installment due to any financial crisis or any problem, then the goods will be taken over by them. So this is somehow a risk. Okay, so obviously this is the strategy of business, but risk is there. Then coming to obligation to complete payments. Customers are obligated to continue making payments until the full amount is settled, limiting flexibility, right? So it is a constant process, so it should be continued till the payment ends. Okay, so then next, coming to installment purchase. Whatever we have now discussed, that is all about our hire purchase. I will show you some practical examples so that you will be more clear about how to deal or how to calculate these hire purchase installments, right? But now we will go for installment purchase. After that we will go to that part of calculation. So now coming to installment purchase. Installment purchase involves customers buying goods and paying for them through equal installments over a specific period, often interest free. So this is the benefit which says that it involves customer buying goods and paying for them through equal installment over a specific period, often interest free. But in hire purchase it is not interest free. Interest is a compulsion there. it may be interest free. Okay, now what are the features? The features is no or low interest rate, right? Customer may benefit from interest free or low interest installment plans, reducing the cost of purchases. That is one benefit, that interest is very low, nominal, or it can be, you can say it can be zero interest free loan. Another benefit is equal payment. Installment amount remains the same throughout the agreed upon period, simplifying budgeting, right? We have to, as it is a fixed amount, after our income we have to keep some part of amount apart for this for paying off our installment. So the calculation is easier for this. Then next, coming to variety of merchants. Installment options are offered by various merchants, making it accessible across different industries. Like installment is a very common thing which we can get from door to door. Even in online transaction also we are able to get installment. If I want to purchase a asset, fixed asset or current asset or anything of my choice from online trading also, like we can order from Amazon or Snapdeal or Flipkart, anything, they are also offering the EMI scheme. So these installment scheme are so much popular nowadays, so everyone can take the benefit of it, and it is very less interest, so everyone can afford this. So what are the various advantages of this installment purchase? So first of all, financial flexibility. Customers can acquire goods without immediately depleting their savings and taking on significant debt. Suppose there is a need to purchase a AC, because nowadays due to this hot atmosphere we need a air conditioner, but we can't afford it because it costs minimum of rupees 40,000. So in such a case, this installment purchase option helps us to buy it by paying some down payment and paying in regular installment. The other amount will be divided in equal installments with interest, so we can afford it and easily avail its services. So there is a financial flexibility. We don't have to go to the private money lender or bank and take a loan and go for purchasing AC. So this is the first benefit of installment purchase. Then coming to the next advantage, it is encourages purchases. Suppose I do not have money, so I may delay my option of purchasing. Like I am in need of AC, but yes, I can survive without AC also. So I will delay the purchase to next year maybe. So this kind of purchases, like this, the sale hampers, because the customer needs something, there is a demand for something, but he do not have that purchasing power. So in such a case, it encourages purchase. So installment plans can motivate customer to make more significant purchase they might have otherwise postponed. So now coming to advantages of installment, we now go for increased affordability. Spreading the cost over several months can make goods more affordable and within reach for customers. That was the main advantage, is that it will be spread over various months. So now coming to disadvantages of installment purchase. There are various disadvantages too, like inflated price. Some merchants may increase the product price to offset the cost for providing installment option. So that is the main disadvantages, because as I have already told, whenever there is an installment purchase, there is also interest in it, which indirectly increases our market price of that product. The market price is 10,000, but we get it in 12,000 due to this installment option. But the thing is that we have to pay it in installment. That is the main benefit. So there are some merchants who, instead of taking a nominal interest rate, they charges high rate and increases the cost to almost 30 to 40%. So this is somehow a problem for the consumer. Then the other disadvantages is restriction and eligibility. Not all customers may qualify for interest-free or low-interest installment plan, limiting accessibility. Right? So everybody can't be the customer of free interest. everybody has to pay installment or the installment interest. Otherwise, how do these companies will survive if everybody will have the same amount and paying in installment? So that's why interest is a compulsion, but yes, for some customers it is free. Maybe there is some term and condition who can avail this. So this is not for everybody. Next disadvantages is minimum purchase requirement. Customer may be required to spend a minimum amount to be eligible for installment plan. So for taking the installment plan, we have to pay a down payment. We have to pay something at least. For purchasing the refrigerator of rupees 10,000 at rupees 12,000, we have to pay minimum down payment of rupees 2,000 to 3,000. Okay, so that is also a disadvantage, is that somehow we have to pay. Then we understood about both the things, hire purchase and installment purchase. Somehow both are looking same advantages, same disadvantages, but there is a little bit difference between them. What are the difference? We will go through now. Now taking the difference between, here we can see hire purchase. In hire purchase, ownership transfer after settlement. Okay, after settlement of all the installments, hire purchaser will get the goods. Okay, he will give the goods. The ownership will be transferred in the name. But in case of installment purchase, when he purchases, paying the down payment, immediately the ownership is transferred. So that is the first difference. Coming to next difference, interest charges may apply in hire purchase, but in installment purchase there is an option of interest free or low interest rate, right? Then coming to third difference, risk of repossession for default is there in hire purchase, but there is no risk of repossession in installment purchase. Okay, so the seller is not going to take out your goods, okay, for non-payment of any interest, but there is a risk in hire purchase here. Then coming to the next difference, flexible repayment terms. Means in hire purchase the repayment terms may be flexible. Somebody have money issue, he can pay less. If somebody have no money issue, then he can pay more in this installment. But in case of installment purchases, the amount of installment is fixed for easy calculation, right? This is one more difference. So coming now next slide, coming to key consideration for consumers. So what are the key consideration for the consumers? Budgeting capability. So access if the hire purchase or installment repayments align with your monthly budget and financial goal. So before going for the hire purchase or installment purchase, what are the factors or what are the things you should consider? So first is your budgeting capability. If you want to buy a car, then it is okay. You can buy the car in hire purchase or installment purchase as per your income, as per your salary or as per your business profit. You will plan for 6 lakh, 10 lakh car. But if you will initially go for hire purchase system and you will go for the Range Rover or anything like 1 crore plus car, then it is out of your budget. So take a wise decision, make your budget. After that, go for the type of option you want. Then next you have to see the interest rate and charges. Where the interest rate is less, where the interest rate is high, everything you should compare. You should compare the rates, the charges from different providers to ensure you are getting the best financing term or not, right? Then next you have to see the payment responsibilities. So understand your obligations and the consequence of missed or delayed payment to avoid default or additional fees. So whatever option you will choose, first of all you will go and you will understand all the terms and conditions, that if in any time I got a problem to pay the delay in payment or any reason I forgot to pay the payment, then what is the penalty or what is the fees for that. So you should be clear, then you will go for any option. Then like that, there are some key considerations for seller too. So first of all, target market analysis. Analyze your target market to determine if offering hire purchase or installment option aligned with their purchasing behavior. Okay, so you have to analyze the market, the target market which you are focusing, to determine if offering hire purchase or installment purchase will align with the purchasing behavior. If really there is a demand and market for this type of options. So you have to analyze. First of all, you have to make the market analysis. After that, you have to go for financial risk assessment. So evaluate the potential financial risk involved with providing hire purchase or installment plan to consumer. So first of all, you have to see the many things. You have to judge the customer through many factors, that whether paying him or giving him the option, the money will be recovered or not. Installment you will get the installment in time, or he will after 2 to 3 installment he will ditch you. So like that, there are so many risks. So first of all, you assess all the risks, financial risks, then you will go for the option. Okay, you give the option to the customer to avail your product. Then coming to next consideration, it is competitive analysis. So research competitors offering and market demand to identify opportunity for differentiated and revenue growth. So you should also go for competitive analysis. So what is going on the market, you have to research for that. Regarding your competitors, you have to research what they are offering, what is the market demand, what are the opportunities, what is the weakness, what is the strength. You have to go for the SWOT analysis, and after that you will accordingly plan for your growth. Then coming to my next slide, higher value on smaller value. So this is related to the hire purchase. So hire purchases are typically offered for higher value goods, right, which a common person or a middle class or poor person cannot afford. That's why this option is for them. So hire purchases are typically for high valued goods such as vehicles or appliances, while installment purchases are commonly used for smaller value goods like electronics or clothes, right. So this is the basic difference between higher value and smaller value hire purchase. Then coming to default and reposition. Defaulting on hire purchase payment may result in reposition of the goods by the seller to recover their losses. It is obvious because it is the business strategy. Wherever the seller feels that his payment will not be received, then to recover his loss, he has to get back his goods from you. So here the reputation hampers. So there is the option for you, that way for which option you have to go. So there is the risk of default and reposition in the hire purchase. Now coming to the practical example of hire purchase, how should you calculate the interest rate, depreciation? Because if you are purchasing an asset, then obviously it should have a depreciated value. So in how many years you have to pay the installment, and what is the charges of interest? So we will have a look on this illustration 3. Okay, here see, X purchased a machine on hire purchase system. The total cash price of the machine is 31,960. So here the total price of the machine is 31,960. Payable 8,000 down. So down payment here is, in the initial payment is known as the down payment. So the initial payment is rupees 8,000, and other you have to pay in installment. The installment goes out as, first installment will be of 12,000, second will be of 10,000, and last one will be of 4,000. So it should be paid at the end of each year. Okay. Now interest is charged at the rate of 5%. Charge depreciation at 10% on SLM. So 10% on SLM depreciation should be charged. So prepare the necessary ledger account. So first of all, we will go to machinery account. So when we purchase a machinery on credit, the journal entry comes that machine is an asset. So as per the real account, debit what comes in, credit what goes out. And here, as it is a credit, so we purchase it from hire vendor. That hire vendor is a person, so it is a personal account. And as per the rule of personal account, debit the receiver, credit the giver. So here when we purchase a machine comes in, so it should be debited, and vendor is the giver of the machine, so he should be credited. So the journal entry comes to machinery account debited, okay, machinery account debited to hire vendor account, right? So in machinery account, we have to put to hire vendor account of 31,960 of the cost of machine. Now every year, as we know, the machinery account is prepared at the end of the year, end day of the year, right? So now depreciation is 10% on SLM. So on 31,960, 10% comes to 3,196, right? So after charging the depreciation, the remaining balance of the machine is 28,764. We got this amount by subtracting the total credit amount with the total debit amount. We get this balancing figure. Means the total debit amount is rupees 31,960. Total credit is rupees 3,196. After deducting this, we get the amount of 28,764. So now at the end of the year, the value of machine which was purchased at 31,960, it becomes 28,764 after providing the depreciation. The same thing will happen in the second year. Second year we have started the value of machine with 28,000 and depreciation is in SLM. In SLM method, the depreciation is fixed. So every year we have to pay the fixed amount of depreciation, right? So again 3,196 depreciation will be provided. So after deducting it from the debit side of the balance, we get the balancing figure 25,568. This shows that rupees 25,568 is the value of machine at the end of the second year. So from the third year, we have to take this balance as brought down. Means next year we have to start with the value of machine 25,568. Again at the year end we have to provide depreciation at the rate of 10%, which comes to again 3,196, right? So at the end of the third year, the value of machine remains 22,372, right? So this is the example of hire purchase of machinery account. I hope you understand this. Next, coming to vendor account. Okay, coming to vendor account, what does the vendor do? First of all, I have shown you the journal entry here. Machinery account debited to vendor account. So in vendor account, machinery will be written as by machinery. Okay, so here you can see it is 31,960 by machinery account. Okay, then what we have done, the vendor, hire vendor has paid the first down payment of rupees 8,000. So whenever we pay, the money goes out. So cash is the real account. So whatever goes out, we have to credit it. So it has been credited to bank rupees 8,000, right? After that, this is the down payment. Suppose in the first year, January 1, we have paid the down payment of 8,000 and we have bought the goods. After that, at the end of the first year, we have paid the first installment, because it was the condition there that first installment should be paid at the end of the first year of rupees 12,000. So we have paid the amount of 12,000 at the end of the first year, right? Again you have to put it to bank account. So now time comes for interest. At the year end, you have to also pay the interest. So how this interest should be calculated? So the price of the machinery is 31,960, right? But we have paid the down payment there. Down payment comes to rupees 8,000. So subtracting this, we get 23,960. Okay, so we have to pay, we have paid the down payment on January 1, so no interest would be paid on the down payment because it was the initial payment. After the remaining balance is 23,960. On this remaining balance, 5% interest would be charged for 1 year. So 5% means 5 by 100 into 23,960, which comes to rupees 1,198. This was shown here. Okay, 1,198. So now the time comes for carried down. Okay, so first of all we have to total the credit amount. It comes to 33,158. Then the total debit amount comes to 8,000 and 12,000, means 20,000. By subtracting credit with the debit, we got the balance of 13,158, which is written as 2 balance carried down. Means next year from starting the vendor has to carry the balance of 13,158. Okay, that is the he have to pay. Now the vendor is paying rupees. We have to first of all go for buy balance brought down. So by doing the buy balance brought down, here you can see so from here carried down, we come here to brought down 13,158. Now when the second year ends, so the second condition, second installment is to pay rupees 10,000 as per the question. So you have to pay to bank. We have to write here because the payment has been gone, the cash is out of our business, so it is 10,000 rupees, right? So now comes the calculation of interest. So how this interest could be paid? So the interest you can calculate by what is the amount after paying the first installment. On that amount only you will pay the interest. So first of all, the cost of machine is 31,960. After that you have paid 8,000 as down payment. After that you have paid 12,000 as first EMI, right? You have paid the first annual interest of 12,000 interest and installment. So now the amount comes to rupees 20,000. If you deduct, it comes to rupees 11,960. But you also have to pay the interest now. This is the cost price of the machinery, but you have not included the interest here. Now the interest should be also paid. So the interest you have calculated here 1,198, you have not yet paid it, so it will be also added, interest on interest, right? So you have to add it. After that your amount comes to 13,158. On this amount you have to pay 5% as interest for your second year, right? So that will be 5 by 100 into 13,158, which comes to rupees 658. Okay, this is here. So you understood, whatever payment you have done, you have to subtract that. After that you have to add the interest, because the interest will be added to the remaining balance on which you have to pay the interest, because the interest is not yet paid. It will be added to the main balance. After that you have to calculate the interest, right? So next, coming to the third year, we will here you can see the in second year the total credit is 13,816. By subtracting the debit balance of 10,000, the balance carried down comes to 3,816. So again in the third year we have to start with the brought down balance of 3,816. Okay, like that the last installment is of rupees 4,000, because 3 years installment has been provided in the question. So the last payment we have made to bank 4,000, right? So here the interest will be calculated by this process, right? But there is no need to go to this process, because as this is the last year, so whatever be the balancing figure, that will be taken as interest, because there should not be any balance carried down, because the accounts will be closing at the end of the third year, so nothing should be carried down. So you can simply take the total of debit balance and total of credit balance as 3819, you can subtract it, and the balancing figure is the interest. Okay, so this is all about the hire vendor account. Now coming to interest account, you can see interest account, interest is a nominal account. So for interest received it will be credited, for interest paid it will be debited. Okay, because as per the rule of nominal account, debit all expenses and losses and credit all incomes and gains, right? So now in interest account, you should remember that as interest is a nominal account, every nominal account is closed at the year end by transferring to PL account, profit and loss account. Every income is credited and every loss is debited, but it will be transferred to PL account. Okay, so now the interest already been calculated. In first year, you can see here the interest is 1198. Already we have calculated it here. The second year, the interest is 658, already calculated here, and the third year is 184, already calculated here. So all these three amounts will be transferred to PL account at the end of the year. So in the first year, you will transfer by profit and loss account the same amount which was debited. Okay, and in second year you transfer the whole 658 to PL account, and in third year again you will transfer all the to PL account. Okay, now coming to next slide. Now coming to next slide, coming to next account, that is depreciation account. So again depreciation is a nominal account. If the depreciation is a loss, because depreciation means decrease in the value of fixed asset due to wear and tear or any other reason. Okay, so as it is a loss, it will finally transfer to PL account. So depreciation is charged on the machinery account. So depreciation to machinery and by PL, it will transfer to by PL. Then again to machinery next year, then it will transfer to PL. Again depreciation to machinery, again third year it is by PL. Because the depreciation is in SLM, so every year the rate is fixed, right? So this is all about the hire purchase example. Likewise, I will go to the installment purchase question. You can see here, on 1st January 2016, OM Oil Company purchased an oil machinery on the installment system. The cash price of the machine was 11,175. So here you can note that the cash price is 11,175, but the oil machine price is not 11,175. Okay, there should not be any fraction in the cost price or market price of anything. So here the price is actually 12,000. Okay, but the cash price is 11,175. So what about the remaining amount? 12,000 minus 11,175, it comes to 825. So this 825 is nothing but the interest, right? So coming to next, rupees 3,000 was to be paid on signing of the agreement, and the balance in 3 installment of 3,000. So here the down payment is 3,000. After that we have to pay rupees 3,000 interest for 3 years. Okay, interest is 5% and 10% is the depreciation on diminishing balance method, means WDV, written down value method. That means the amount of depreciation changes every year. Okay, so going to that, first of all we will go to this journal entries. So it is a compound journal entry. We have I am showing you the data of 2016, 17 and 18 at a time. Okay, here you can see that first of all a machinery is purchased I am writing in the book of Om Oil Company. Okay, in the book of Om Company, machinery will be debited because Om Oil Company has purchased the machinery from Delhi Manufacturing Company, right? So he is the buyer. Om is the buyer and Delhi Manufacturing Company is the seller here. So now we are making the journal entry in the book of the buyer, right? Sorry. Now the journal entry will be machinery account debited to to Delhi Manufacturing Company, because we have purchased it in credit. So we will credit Delhi Manufacturing Company and we will treat it. The company is also a personal account because it comes under artificial personal account. So what is artificial personal account now? So artificial personal account is the account which is artificially created by law. Okay, this is the account which is artificially created by law. Law recognizes them as persons, but they are not actually persons. So all companies, industries, all banks come under this artificial personal account. Now the Delhi Manufacturing Company is also a artificial personal account. So as per the personal account rule, debit the receiver, credit the giver. So Delhi Manufacturing Company is giving us the oil. So that's why we have credited Delhi Manufacturing Company, and machinery is coming to us as it is the asset, so we have debited it. Now the balancing figure is the interest, as we do not know how this interest came of rupees 825, which I have shown you here, that this 12,000 will be subtracted from the cash price and we will get this 825. But how actually this 825 will be dealt with? So that's why we will put it as interest suspense account, because this suspense is not yet clear. So we have put it here, interest suspense account. So gradually, by putting the journal entry, your doubt will be cleared regarding this interest. So here you can see next is the payment to the vendor. As it was already mentioned in the question that initially the down payment you have to pay rupees 3,000, and in every year for 3 years you have to pay 3,000. So when you pay the down payment, the Delhi company account debited to bank account, right? So the payment has been gone from the bank, from the business. Now next you have to pay the interest. Look, in January 1 you have paid the down payment. So in December 31, after 1 year, you have to pay the interest. So calculating the interest is given in the question at the rate of 5%, right? So what is the cost now? So the cost of the machine is, here the cost comes to 11,175. The cash price is 11,175 and the down payment we have given is 3,000, right? So the total amount is 8,175. So in this amount 5% interest will be charged. Okay, you are getting my point? So we have to subtract the cash amount, the down payment, from the actual cash price. Then we will get the amount which we have to pay in 1 year. On this we have to calculate the interest at the rate of 5%, and this comes to rupees 409, right? Which we can see here, interest account debited to interest suspense account. As in the January 1 there is a suspense account is opened, so we get a clarity that from out of this 825 amount, 409 amount is for the first installment EMI interest. Okay, it is the interest of the first year. So other balance we will get gradually. Next, at the end of the year, the first installment should be paid. So Delhi Manufacturing Company to bank. This will be the journal entry, and the first rupees 3,000 is again paid, right? Next, at the year end, machine will be depreciated. So depreciation account debited to machinery. Depreciation is a loss, so it will be debited, and machinery value got decreased. So when the asset decreases, it should be credited as per the modern method of golden rules of accounting. So depreciation is charged at the rate of 10%. The value of machine is 11,175. its 10% comes to 1100 and 1117.5. So we will make it approximately 1118. Okay, so at the year end, as I have told you before, at the year end all the expenses or losses will be transferred to PL account. So here there are two losses for the company, one is paying the interest, one is depreciation. Okay, so these two are the fixed expenses which they have to pay. This fixed expense will be transferred to PL account. So PL account will be debited, and this interest and depreciation which was debited before will be credited now and treated as transferred. So the total amount of 1525 transferred to PL account. So this is all about the journal entries. Now coming to machinery account. So regarding machinery account, machinery has been purchased from Delhi Manufacturing Company. So in January 2016, we should give a debit to Delhi company as rupees 11,175. So in machinery account we have to show the depreciation account debited to machinery account. The value of 1118 we have already calculated. So the remaining balance of the machine is 10,057. We have to total the debit amount and we have to subtract the credit amount, and we will get the carried down amount. So next year we have to start the machinery balance with rupees 10,057. Okay. Now every year the depreciation is charged. It is a fixed loss, right? So but here now the depreciation is charged on WDP. So we will not take the depreciation amount as fixed as we have taken in the previous question, right? So we have to now calculate the depreciation on the balancing amount. Here the balancing amount is 10,057. We have to take 10% of this, which comes to 1005.7. Approximately it comes to 1006, right? So the carried down comes to 9,051. Then in third year again we have to start this with the same balance 9,051, and depreciation should be calculated on this only as per WDP method. Okay, so 10% on 9,051 comes to 905. Okay, then the carried down amount is this. So that means the machinery purchased on 11,175, now it shows 8,146 as balance, right? Okay, now we will go to interest suspense account. So coming to interest suspense account, you can see here the total interest we have to pay is 825. So in first year the interest is 409. I have already shown you the calculation in the above slides. So by subtracting the debit with the credit amount, we get rupees 416 as the balance carried down. Coming to the next slide, you can see in the second year the balance brought down is 416 and the second year interest is 279. So the balance figure comes to 157. So as in case of hire purchase and installment purchase, the main important thing is the calculation of interest. So let me show you once again how this interest should be calculated. Okay, so here in first year the interest is 409. How does it came? So let me show you once again. So the according to question, the cash price of the oil is 11,175. Okay, and the down payment is rupees 3,000. So it will be subtracted and the amount comes to 175. So the interest should be paid at the rate of 5% on this amount. Okay, so if we will calculate 5% on 8,175, it comes to rupees 409. Okay, this is the first interest we have to pay. After that, in the second year interest, how will you calculate the second year interest? So we know that the total cash price, right, the total cash price amounts to rupees 11,175. The down payment made is rupees 3,000 and the first installment paid is rupees 3,000. So after subtracting all this amount, cash price 11,175, we will subtract the down payment of 3,000 and we will subtract the first installment of 1,000 at the year end of first year. So now the amount we have to pay comes to whatever be the amount it comes, we have to add interest in it, right? So interest of rupees 409, because this interest is due but it is not paid. So in the balancing figure it will added. After that the interest will be charged, right? So we have to subtract the down payment and the installment amount. After that we have to add the interest to get the actual amount, and here the actual amount will come to 5,000. It is 11,000. If you will subtract, it will comes to 8,175, and after that we will deduct, it will come to 5,175, and we have to add 409, it will come to 5,584, right? So in from this 5,584 we have to calculate interest of 5%. Okay, so it will come 279. It is our second year interest. So I hope you understand this. So in the first year calculation of interest, we have only taken the cash price. From there we have deducted the down payment and we have calculated the interest 5%. But in the second year, before calculating the interest, we have to first add back the unpaid interest. We have to add back it. After that we have to deduct the down payment, and also we have to deduct the first installment we have paid. Accordingly we can get the amount, and 5,584, in that we have to pay 5% interest, 279, right? Now the balancing figure comes to 137. In the third year the balance brought down comes to 137, and the interest calculation is not necessary to be done in this process, because here the interest is already with the balancing figure, as the account should be closed in 3 installment maximum. So in the last year whatever be the brought down amount, that will be the interest amount, right? So here the interest suspense account is done. Now coming to the next account, Delhi Manufacturing Company account. Here Delhi Manufacturing Company is the creditor, so we have to pay him the amount because we have purchased some machinery from him, right? So by machinery account 11,175. This is the as we have I have told in my first line that the journal entry for purchasing the machinery will be machinery account debited to creditor account, that is Delhi Manufacturing Company account. So here in the creditor account there should be buy machinery, okay, 11,175, and we have also paid the interest of 825, right? At the year end, initially we have paid 3,000 as down payment, and after 1 year we have paid the amount of 3,000 as first installment. So now total credit comes to 12,000 and total debit comes to 6,000. After deducting the credit with debit, we get rupees 6,000 as buy balance carried down. Okay, in second year we have to start with that balance brought down of rupees 6,000, and we have to pay the second installment of rupees 3,000. Now the balancing figure will be 6,000 minus 3,000, it will be 3,000, right? And again in the next year, last year, we have to start with rupees 3,000, and as it is the last year, the whole amount of rupees 3,000 is paid as interest. So the amount will be balanced with each other, right? So the Delhi Manufacturing account will be closed. Next, coming to interest account. Here interest is a nominal account. So as per nominal account rule, all the expenses should be debited, and at the end of the year it will be transferred to PL account, right? So here interest is debited and transferred to interest suspense account. Okay, Now this 409 rupees of the first year interest is transferred to PL account in this first year end. Likewise, in the second year, the interest comes to 279, it was transferred to PL account as 279. Then likewise at the third year, the interest comes to 137 and it is transferred to PL account as 137. Okay. Now coming to depreciation account, depreciation is also a nominal account because it is a loss. So as per rule of depreciation, debit all as per rule of the nominal account, debit all expenses, so depreciation will be debited. Depreciation is nothing but it is a decrease in the value of fixed asset due to wear and tear or any other reason. So it is a loss, so it is charged on the machinery because after depreciation the machinery value decreases, so it is credited. The first year it is credited with 1118 and this loss is transferred to PL account with the same amount of 1118. Second year the loss is the transfer of depreciation to machinery account is 1006 and it will transfer to PL account as 1006. Last year the same thing happens, it will be transferred to PL account with 905. So this is all about the journal entries in the book of the buyer who is going to opt for the option of hire purchase or installment purchase, right. This is the case of installment purchase. So this is from the point of view of the creditor or from the point of view of the seller, we have to now put the journal entries. Okay. So for Delhi Manufacturing Company, OM Oil Company is the debtors. So as he had sold the machinery on credit to them, so he will definitely receive it in future. So OM Oil Company is the receiver of the machinery, so it should be debited and sales will be credited and interest will be credited because here interest is received. As interest is the nominal account, so it should be credited as interest suspense account with rupees 825. Okay. Now coming to it is the just the vice versa of the buyer's account because whatever there is debit, like their money was going, so their bank account is credited, but here in account of seller he is receiving the cash, so here cash account will be debited. So everything is vice versa in the both books. So now when the down payment is received, suppose I am the Delhi Manufacturing Company and I am receiving the down payment, so my bank account will be debited because as per the rule of real account, debit what comes and credit what goes out, and the money is I am receiving, so that it is coming to me, so it will be debited and OM Oil will be credited with rupees 3000. Then I am receiving the interest, so my interest will be credited and transferred to interest suspense account for the first year 409, second year 279, third year 137. Okay. Then next coming to installment. So as per the condition and as per the question, in 3 years equally he has to pay 3000. So in first year I have received bank account debited to OM 3000, second year 3000, third year 3000. Like that at the year end I have received whatever interest I have received, I will transfer it to PL account. So 409, 217 and 137 is transferred to PL account. Here interest is my income, right. So PL account will be credited because income means it is a credit item, and as per the nominal account rule, credit all incomes and losses. So interest is credited, but when it is transferred to PL account, interest will be debited and ultimately the PL account will be credited, right. So this is all about your journal entry in the book of Delhi Manufacturing Company. Now coming to account of OM Oil Company. So whatever we have put in the journal, we have to show it in the ledger account of oil company. Here you can see to sales account, to interest account, this 11,175 and 825 as it was already we have already calculated. Then we have received from oil company 3000 as down payment, 3000 as first installment. So these are recorded as buyback because we have received the money. Now the balancing figure is 6000. Next year we have to start with the same amount of 6000 and we have received the second installment of 3000. So the carried down will be 3000. Next, coming to the third year, we have started with the amount of 3000 and we have done this through bank account 3000. It will tally, right, because the OM account will be closed. Now coming to interest suspense account. So in interest suspense account, the 3 years interest will be transferred. Okay, so first year interest is 409. So interest suspense account debited to interest account, and ultimately these expenses will be bear by OM Oil company. So first year there is a liability of 825, but after paying the interest of 409, now the balancing figure is 416. So in second year, after paying the interest of 279, the balancing figure will be 137. So for the last year, the whole amount will be given as interest. There is no need to calculate. So this is about the interest suspense account. Next, coming to interest account, as interest is the income for the seller. So here the interest suspense account will be shown on the credit side for the 3 years, and all the 3 years at the end of the 3 years, at the end of the first year, rupees 409 is transferred to PL account on the debit side. Usually second year interest will be debited to PL account and third year interest will be debited to PL account with the same amount as reflected in first year, second year and third year. Okay, next this is about this installment purchase account. I hope you understand this, but still you will also again go through my video. You will be clear more if you will once again you will watch this. Next, coming to the conclusion part, I want to say that hire purchase and installment purchase are valuable consumer financing options. Hire purchase provider, in hire purchase, ownership is provided after settlement of payment, while in case of installment purchase, immediate ownership is allowed. That is the main difference, I think, because interest is in both. We have already calculated, so both carries interest. Maybe somebody in some option there is less interest, in some opt for more interest, but there is a part of interest. But the thing is that the ownership, so in case of hire purchase, ownership is not given to you until and unless your all the installments are clear. But in case of installment purchase, you will be ownership will be given to you immediately, and rather after that you have to pay the installments in time. So as per my suggestion, first of all, for you have both the options, but for opting any of the choice, you have to consider your budget, your obligations and interest rate. Okay, you have to compare between various providers and also with both the schemes, terms and conditions. After that you should opt for the option, right? So this is all about today's video class on installment and hire purchase. So I hope you really understand. Thank you.